Welcome to the Keiser Report. I'm Max Keiser. Let the blood bathing begin. Stacy.
Max, there's a bloodbath in the markets, and it started in the Gulf, the Persian Gulf, or the Arabian Gulf, as some people call it. The Saudi, the Qatari, the Kuwaiti, all these markets are tumbling. Dubai was down almost 8% at one point. MR Properties was down 8%. Remember, with the previous financial crisis, the previous financial crash, it was the same property group who went bankrupt, essentially, and Abu Dhabi came in and rescued it all. But a lot of this is driven, obviously, by oil, the oil price crash, just as in 2008. And the first headline, oil price collapse, claims West Australian Red Fork Energy shale gas company in receivership. The collapse of the oil price has snared its first West Australian victim, with Red Fork Energy losing the support of its major lender.
Well, the shale industry, as we've been pointing out, is unsustainable. Even with oil at $120 a barrel, the shale industry in America, shale oil, shale gas, was an economically unviable hoax. So with oil at $50, $60 a barrel, then the bankruptcies will tumble through that industry and cascade through the entire global financial market. And what's interesting is that banks, you mentioned 2008. Before the crash of 2008, banks were buying insurance on other banks because they were the counterparties. They held the risk that the originator of the loan would have. They'd sell it off to another bank. But they realized that the other bank was insolvent, so they were buying insurance on the other bank, and then that bank looks at the original bank and says, wait a minute, those guys are insolvent, and they're buying insurance on that bank. So we see the market for bank insurance in the credit default swap market go up because the banks know that we're getting ready for another huge bank failure.
Yes, and you know, we were one of the first people in the world to be warning of this back at $120 a barrel of oil about the shale industry. But most importantly, people pouring money into the junk bond market. Okay, you know, the prospectors themselves, fair enough. You want to go out there and, you know, prospect and try to find your little barrel of oil to sell to the market and make your fortune. That's one thing. But who is buying these junk bonds at 4.5%? By the way, at one point that was the lowest the average of the energy junk bond market went. Is like, who is taking so much risk for so little money? And now Bloomberg News is asking the same question. I say, Fed bubble bursts and $550 billion of energy debt. The danger of stimulus-induced bubbles is starting to play out in the market for energy company debt. Since early 2010, energy producers have raised $550 billion of new bonds and loans as the Federal Reserve held borrowing costs near zero. With oil prices plunging, investors are questioning the ability of some issuers to meet their debt obligations. Research firm Credit Insights predicts the default rate for energy junk bonds will double to 8% next year. Many are saying it's going to be far more than that.
All right, the income from a junk bond is used to collateralize more bond issuance. And so it's $550 billion origination in the junk bond relating to this shale industry, but it's collateral for hundreds of billions and probably $1 trillion or more in loans throughout the system. So if you pull the rug out from underneath this, you know, what's interesting is that the peak oil scenario, which people were talking about for a long, long time, was hinting at peak supply, that the supply of oil would hit an unsustainable level. But in fact, it looks like at the moment anyway, the peak oil scenario can be characterized as we had peak demand. In other words, the economy is going into massive deflation, and the demand for oil is what's driving the price down, is that there is no demand for oil, relatively speaking, and all the money printing in the world is simply going into a black hole of debt and not stimulating enough economic activity to up the demand for oil.
So, I mean, let's talk about the last crisis. It was called the credit crunch, because remember, there was no credit available. Now we saw this with the Red Fork Energy. So their credit is being pulled, their credit lines are being pulled. In the shale oil industry across America, you're also seeing that credit lines are being pulled. They can't raise new money to roll over all of this debt. You also see the fact that the bid is being pulled on the oil. This is why people are describing how the price of oil is crashing, is because there's no bid. There's nobody bidding for it.
Yeah, well, I mean, the old debate was inflation versus deflation. Yeah. And the people who said, no, we're having inflation, would say, look at the price of oil. Well, the price of oil was being held up by the cartel, OPEC. Now OPEC has walked away from the cartel. They've pulled their bid. So now the price of oil reflects deflationary trends around the world, and it crashed.
But again, the price, demand price, companies go out of business and stuff like that. But it's the knock-on effect, all the derivatives. Remember, with this new budget, the $1.1 trillion budget that's passed the Congress, that the derivatives are now back on the books of the taxpayer in America. So when these derivatives are, that's what is going to drive everything into chaos and a spiral like we had in 2008. And this Bloomberg article points out that the Fed's decision to keep benchmark interest rates at record lows for 6 years has encouraged investors to funnel cash into speculative-grade securities to generate returns, raising concerns that risks were being overlooked. A report from Moody's Investor Service this week found that investor protections and corporate debt are at an all-time low, while average yields on junk bonds were recently lower than what investment-grade companies were paying before the credit crisis. So here, this is something that the Keiser report has been saying over and over for the past few years, is that these 0% interest rates were driving people who had no reason to be there, these mutual funds, these pension funds, were driving into these junk bond markets that they were not being paid for the risk they were taking.
Right. Well, these huge pension funds have to make a certain amount of money every single year to pay off the pensioners, to avoid going bankrupt, becoming, running out of money to pay the pensioners. And so they are always in the business looking for a yield, looking for ways to get enough income on their securities to pay off their pensioners. And the government bond market went to zero because of the zero interest rate policies. So they look at the corporate bond market, and the corporate bond market was jacked up to a level where they weren't getting enough yield for their pension account obligations. So then they go to junk bonds in the oil sector market, and they drove the price up to the point where the yield at 5% is what the government bonds used to be paying 15 years ago. So now, with the collapse of that pyramid scheme of the junk bond shale, Wall Street financed Ponzi, all these things are now being realized that they can't pay.
Again, the other thing that's been bad throughout this so-called recovery has been wages across the UK, the US, Europe have declined in real terms by 9%. So the article also points out that employment and support services for oil and gas operations has surged 70% since the US expansion began in June 2009, while oil and gas extraction payrolls have climbed 34%. But this takes us to the next headline: tumbling oil could take thousands of jobs with it. So Halliburton has just announced huge layoffs. We saw the last episode, Norway has let go 7,000 jobs, paying on average $180,000. Well, according to Fatima Iqbal of Azad Asset Management, over 15% of total employment gains since the beginning of 2008 have come from the energy industry, even though it is less than 1% of the country's job base. So the average income in the oil services sector in America is $96,844. And now some people are going to say, well, the consumer gets more income because of $1.1 trillion or $1 trillion worth of lower oil gasoline prices. So it might drive more consumer demand, but those jobs in the retail sector in America averages like $21,000 a year.
Right. Well, that's deflation. So that's more deflation.
Yeah.
And now here's where the interesting split in economic theory occurs, because there are those who believe that all this massive money printing that's going on to try to stimulate the economy is a dead end, because you're just basically providing a blood transfusion for a corpse. So they advocate, let the bonds default, let the banks default, let the economy find its level of where prices can clear without the government being the market maker, because then that would no longer be capitalism. That would be more of a state-sponsored, socialist model. Then there are those like in the New York Times, Paul Krugman, who says that the reason why there's no growth and why deflation keeps ravaging through the global system is because there's not enough money printing. So he would encourage doubling and tripling and make the debt of the United States go from $18 trillion to $36 trillion or $72 trillion. That's what they believe. The Keynesians believe that there's no penalty for debt. Now, the one country that's experimenting with this would be in Japan, where the debt to GDP is approaching 300%. They just got a mandate to put Abenomics to extend this model, even though the yen is crashing, There's no growth whatsoever, and all that money printing is going into failed experiments like shale gas and shale oil, which is like putting money into a company that loses 50 cents on every dollar they generate.
Also, so here we're talking about the crash possibly happening in the credit derivatives market regarding shale oil and in the energy junk bond market, but we're at 0% interest rates already. So what are the Fed, what are ECB, what are these people going to do? But on top of that, we've always had Japan, and Japan had massive savings. And that's now been depleted completely over the 30 years. That 300% GDP, debt to GDP ratio, at least it was from domestic savings. It's not from outside debt holders. But they're at the point where they've depleted domestic savings. That's all gone. They're going to have to go out to the market. So this is the world, the credit market into the credit world into which this next wave is going to come. Who knows what's going to happen with it at this point? Yeah,
well, I mean, it's interesting culturally speaking in Japan. I read something, I think it was on Zero Hedge, talking about this, is that culturally their imperial past and their sense of entitlement as a culture that is deserves to be much higher up in the global rankings in terms of their economic prowess than they currently are, would lend them to this possibility of committing essentially this financial suicide. In other words, they're going to print so much. They're going to if they can't be running the world, then nobody's going to run the world. This is a form of financial kamikazeism. They're going to strap on, load up the zero bomber with quantitative easing and dive headlong, into the super tanker destroyer that is the world economy and blow everybody up. And culturally speaking, you can make a case for this. This is a culture that is known for their ceremonial sepulchre, which I always mispronounce, and this is their mindset.
Well, the mindset of the American who's losing the most here, I think, is that they go into the schoolyard and blow away all their fellow classmates. I think this is what's happened in the energy market. This was the last gasp of a credit derivative world that is about to it's interesting that they go into the gasoline and energy and it's going to combust and blow up the whole thing.
Yeah, well, we could be that kindling, perhaps, a little spark, and we could be the ones that blow up the world. Yeah, baby, light my fire. Stay tuned for the second half, a whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to a friend of mine, Brian Rose. He's a banker turned TV impresario, just like me. He runs a thing called London Real TV in Silicon Reel, right here in London, near Silicon Roundabout. And he's here today. Brian, welcome to the Keiser Report.
Thank you, Max. It's so nice to be here. We miss you on my show. You were on London Reel and Silicon Reel 3 different times. One of our most requested guests. You announced Start Join on our show, so it's...
That's right. It launched the whole thing on your show. Because over there on Silicon Reel and the other properties that you're involved with, it's really interesting in that you are riding this wave of independent media. And the setup over there is fantastic. You were the first guy that I know that used little GoPro cameras and little cameras and set up your own mini studio. But the quality is excellent. And how did you make the transition? So you were in banking, as I was, and then now you're doing this. So how did that transition happen?
It's a great question, Max. I was in 10 years at a credit derivatives broker in the city. I moved to London specifically for that. Now I'm a citizen here, and I did that whole racket. Some of my clients were Goldman, sometimes JP Morgan, and I was broking those high-yield credit derivatives on the phones for a FTSE 100 company. And I had enough one day. I just walked out, had no idea what I was going to do, and then I started broadcasting from my studio in Shoreditch. You've been there. We started with London Reel, which has been going for 3 years, which is really about people and ideas that change the world. We've had you on talking about Bitcoin. We've had other guys in finance like Peter Schiff. We had Jim Rogers. We've also had activists like Andy Michon, Jesselyn Radick, that kind of thing.
Let me jump in for a second because you mentioned this transition from banking to independent producer, and I would imagine it's a lot more satisfying for you than credit derivative dealing. And I just thought of this question just now, but there's been, I want to ask you, as a fellow banker, as an American also, there's been a spate of banker suicides, in the last year or so. People they're suicide, they're getting killed, and to me, it's people have a conspiracy theory about it. But for me, I think these are bankers that never transitioned away from something that was killing them, being in the soulless derivatives market. What do you think? Would you agree with that, or how do you see it?
I would totally agree with that. So I'm giving a TED Talk in January, and part of me is talking about the fact that I just wasn't happy. It is a soulless existence. There's no community. You're not creating anything. And that's the thing that I think a lot of guys run into, especially when they're told their whole lives that once you become a banker, once you make all this money, you're going to be happy. And ultimately, you're just not. And so that's why I think I went running away from it, because there's no innovation, there's no creativity. That's why being in the tech space is a lot of fun for me. It's the innovator's dilemma for a lot of these banks. You know, they have these markets locked down and they don't want anybody to touch them, as you know.
Yeah, I talked to Nomi Prinz, author and former Goldman Sachs partner, and she had said the same thing, that she could have been one of these suicide bankers had she not left the industry. Well, we're glad you made the transition. Glad you're here
Glad
with
I didn't
us.
kill myself.
You didn't jump off a building. Now I want to talk about Silicon Roundabout, or Tech City as it's called, because you and I have had these conversations before. The culture in the UK and in Europe as a whole, it's not like Silicon Valley. In America, let me put it this way. In America, it's a badge of honor to fail. In Europe and in the UK, if you fail, you're immediately a failure for life and nobody will touch you. You have the stink of failure about you. And of course, that doesn't work with an entrepreneurial startup culture. You need to fail a few times before you get it right. Is this changing, or is this still the situation? Talk about the mindset of the startup industry here in the UK.
Sure, no problem. Well, Silicon Reel is my tech show. You know, it's about technology disrupting London. So we shoot that out of the same studio every week, and we talk to the founders and CEOs that are building these companies and technology that are ruining all the industries that you and I know and love, including your favorite banking, politics, retail, manufacturing, transport. We had Uber on a couple weeks ago, just raised $2 billion, $40 billion valuation. But like you said, everyone looks to Silicon Valley. What can we learn from the Yanks? Because when the Yanks pitch a deal, my company's a $10 billion company. When the Brits pitch a deal, they're thinking maybe it'll be 100 million. So they kind of lack that scale of as far as how big they can scale up. Part of that is because we live in the UK and there's 70 million people, and Europe has different languages.
That's a great point. In other words, when you think of scaling up in the UK, if you get every single person in the UK in your business, that's 70 million people, which is on a global basis not much.
Right.
But the mindset is, I'm going to get everyone in this country to do this. Well, maybe if you do, that's still peanuts.
Right.
In the U.S., it's always about getting 330 million in the U.S. and getting 5 billion globally. So it's just a mindset here in the U.K. is still small-minded.
It's true, but what we are finding is fintech, financial technology. London right now is the best in the world, and it's because the banks behind us that we can see here are right next to where I am in the Silicon Roundabout, where tech is. And so you're seeing these big fintech plays. One of them is called TransferWise, where you can now move currencies from person to person. You don't have to go through the bank and get scalped. And there's other companies like Nutmeg and Doodle. And these companies, funny enough, Max, they're not trying to go to the U.S. because there's lots of funny securities laws in the U.S. Equity crowdfunding you still can't do in the U.S. Every state has different laws. So they kind of want to own the UK. UK, I think, is still one of the most connected populations in the world. E-commerce is a higher percentage of UK citizens than the U.S. So some of these companies are trying to own this market and then move to the U.S. But yes, in the long run, you're going to have to conquer the U.S. market.
But there is a change in terms of you see it from your perch
I definitely
over
do.
there in Silicon Reel.
The big part is funding. We never had that Series A funding, which is kind of that $1 million to $2 million to really get people off the ground. We saw the later funding. We had IPOs this year, Just Eat, and a few other billion-dollar exits, and that makes people happy. It puts money in the VC's pockets, so now they can go out there and spend it. So, yeah, Max, I'm seeing a big change. We've seen 20, 25 million, $50 million fundings in this year alone that we've never seen a few years ago. So it feels frothy. It doesn't feel bubbly. I know you saw the first bubble in tech. I was involved in it in New York City. This feels frothy, but it doesn't feel like a bubble. There's real revenues here.
Right, there are real revenues, and people like to see that type of thing. Of the guests that you've covered, and you've had some remarkable guests on the show, and including the fella who hosts the new version of Cosmos.
Yes, Neil deGrasse Tyson.
Neil deGrasse Tyson.
Yes.
And that's an interesting guest to have. What was he? Tell us about that a little bit, because I think he's one of your most popular guests. I think you have maybe 200,000 views or so.
Yeah, 200,000 views, just a few more than you, but it's still early days. So
no, but he's a phenomenon, a global phenomenon.
He really is.
And how did you get him?
he is a celebrity astrophysicist. That career didn't exist, a year ago, and he rebooted Cosmos, which was the original Carl Sagan series. I'm sure you remember from 20, 30 years ago, and he rebooted it with Carl's ex-wife after he died. So he came through. I got the chance to interview him. As we know on London Real, we have people like you talking about finance. We've got whistleblowers, but sometimes we like to have some fun, and so I got an hour with him. He walked into the room, and he didn't know who I was. And Neil can be a little feisty, and if you see in the beginning, he's really pushing me, and he's like, "Really, Brian, really?" And at the end of the show, he grabbed me in a wrestling hold and put me in a headlock. But I wanted to get his thoughts as far as what his life was like, how he came from a kid in the Bronx and then brought up into where he became kind of a defender of the nerds in high school. He was a wrestler, and then to become one of these most outspoken scientists.
Okay,
he transcends it.
But the idea here, though, is here's a guy who I would have normally seen on 60 Minutes on CBS, right? Because he's a phenomenally successful guy right now, but here he is on your show, which you're just essentially you've transformed your flat in East London into a studio,
right?
But the quality is the same, the questions are the same, and it was a phenomenal interview, and everyone, obviously, the numbers are there.
Well, it's on demand now, so anyone can watch it on iTunes and YouTube. So what's the difference? I mean, it's helped to be on television, and you convinced me of that. Television is still going to be around, but these days, with things on demand, as long as the quality is up there, like you said, then people, why not watch us on YouTube? Why not? And plus, it's a little more real. I'm not censored. I can talk about anything we want, and it's unedited, uncut. I think people kind of like that realness these days.
Okay, so let's talk about the kind of the regulatory framework, because what happens is, when you get successful, the entrenched oligopolists here in this country, they call up the regulators. What's up with this upstart? We don't want the competition. What can you do to block them? Do you see this trend? Is this how do you see this moving forward? You're an independent. You're competing with the majors. They've got the regulators captured, essentially. How do you deal with that, if at all?
I mean, it's a concern. It's a luxury we've had for a few years now. And I had George Galloway on my show 2 years ago. He came in, saw my setup, and he was like, he's used to doing radio all his life. He said, there's no regulation, there's no Ofcon, and he started a podcast the next week. So, he saw something there as well. YouTube is a global American company owned by Google. iTunes is a global company, backed by Apple. I don't see them they're going to be pushed by Ofcon. But that could happen. But I just don't see, when you have on-demand and so many different possible devices, I don't know how you're going to censor that. How can they censor us on Twitter? How can they censor these micro pieces of content like Vine? I don't know, Max. I mean, I think it'll be a real shame if they try.
Yeah, well, certainly this whole market is opening up. Also, on your show, I think when you got started, I was just kind of curious. I'm going to ask you about this. A lot of the guests, and certainly the highest profile guests, are in the, I guess you call it the bodybuilding arena and physical awareness and things like that.
Yes.
And I think you've had some experience with that, with competitive boxing and kickboxing and things. But this is another alternative sports, if you will. The what do they call it? MMA or
MMA, mixed martial arts.
Mixed martial arts. These are sports that have come out of nowhere, but through alternative media have found an audience. And, what do you make of this deal or this company called Twitch, where you watch people play video games? When you saw that, what was your first reaction? Like, why didn't I think of that? Or what's your first thing when you thought of this?
Well, it's the concept called the long tail. So no longer are we all watching the same blockbuster movies. We don't all go see the movie Jaws. We don't buy Michael Jackson's album. Now we can find the content that we like. And all I really need is a few million people that want to log in, watch my stuff, buy my stuff from my advertisers, and I win. So I can find these little niche sports like MMA. I can find someone who wants to hear about a bodybuilder, Dorian Yates from Britain, talk about for an hour and a half. So I can kind of hit these small target audiences with this kind of online delivered media. So it's an exciting time.
All right, we got about a minute left. I want to touch on another subject here in terms of government and media. So here, there's some spark of a success in the Silicon Roundabout area. It seems like the government, mayor's office, have kind of like woken up to this and are now like glomming onto it, in my opinion.
There's a lot of media appearances.
So is that helpful or hurtful? Because in other words, I mean, you could make the case, oh, it's helpful. They're coming in with some money. They're coming in with some awareness. But on the same token, you could say it might be hurtful because these are the same bureaucrats that have kept us from growing for decades. Do you really want them coming in at this point, or what do you think?
It's nice to see Boris coming out and kissing babies and shaking hands, and that only helps when the government's getting involved. But what we really need is, the immigration reform. We've had some great tax treatment, but we really need to see it and feel it on the ground, whether it comes to broadband speeds and all that kind of things.
Broadband speeds. That's one thing they definitely need in this country. Boris, if you're listening, we need world-class broadband speeds. It's still dial-up. All right, Brian Rose, we're out of time. Thanks so much for being on the Keiser Report.
Thank you, Max. Appreciate it.
All right, that's going to do it for this edition of the Keiser Report. With me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Brian Rose of London Real TV. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.